This is short answer type questions of chapter 6 1. Question 1. What is the objective behind preparing an account? What is meant by recording on debit and credit side of any account? Explain with examples. Short answer type questions. Answer 1. The objective behind preparing an account is to summarize all transactions relating to a particular head in one account. Balance of all the accounts lead to preparation of a trial balance. Recording on debit side of any account means an item recorded on the debit side of an account is said to be debited to the account. A debit entry signifies that the value has been flowed to the named account. For example, cash paid into bank, e.g. bank account debited to cash account credited, means that cash has flown into bank account. Recording on credit side of any account means an item recorded on the credit side of an account is said to be credited to the account. A credit entry signifies that the value has flowed out of the named account. For example, cash withdrawn from bank is cash account debited to bank account credited. That means cash has flown out from bank account. Then question 2. Give the rules of a debit and credit and explain them with imaginary examples. Under double entry system of accounting, each transaction has two aspects. One aspect is debit aspect and that is receiving or incoming aspect. Another aspect is credit aspect, that is giving or outgoing aspect. The rules can be summarized as follows. 1. Increases in assets are debits, decreases are credits. For example, plant purchased is debited and sold is credited. B part. Increases in liabilities are credits and decreases are debits. For example, bank loan taken is credited and repaid is debited. C part. Increases in owner's capital are credits, decreases are debits. For example, further capital introduced is credited and withdrawn is debited. D part. Increases in expenses are debits and decreases are credits. For example, increase in rent paid is debited and decrease is credited. Then E part. Increases in revenues or incomes are credits, decreases are debits. For example, increase in rent received is credited and decrease is debited. Then answer 3. Here the question 3 is, write a short note on balancing an account. Explain by balancing a cash account. Answer 3. At the end of a period, say a day, a week, a month or year, it may be necessary to know the balance in an account. A balance of an account is the difference between the total of its debit and credit sides. If the total of a debit side is more than the total of credit side, the account is said to have a debit balance, it has a credit balance when total of a credit side is more than total of a debit side. For example, we can better understand with the help of a cash account. Started business with the cash is transaction 1 rupees 15,000, rent paid 2,000, sold goods 5,000, purchased goods for cash rupees 3,200, salary paid rupees 3,000. Solution. It is a cash account with debit credit balance. If something is cash is flowing in, then it is increase plus in the debit side. If it is flowing out, it is in credit side and decrease minus. First one, started business with cash. It is cash account debited to capital account flowing in. Next one is rent paid to rent account debited to cash account. Cash is flowing out by rent account rupees 2,000. The next one is sold goods for cash. Cash account debited to sales account. Cash is flowing into the business, hence flowing in to sales 5,000. Next one is purchased goods. Cash is flowing out by purchases. Purchase 3,200 in the decrease side. Cash is decreasing, flowing out. Next one is salaries paid. Cash is flowing out of the business by salaries rupees 3,000. Then we have to balance. You see, debit side amount is 20,000. Credit side is rupees 8,200. Write down 20,000 and take it to the credit side. Find the difference. Balance carried down. Gap. 20,000 minus 8,200. That is rupees 11,200. Take it to the debit side. Write down. Balance down. That is 11,200. The next one is answer 4. The question 4 is, this is chapter 4. What do you understand by debit and credit? Do you think that debit always stands for decrease in amount and credit for increase? Answer 4. Debit refers to the left side of an account and credit refers to the right side of an account. An item recorded on the debit side of an account is said to be debited to the account. A debit entry signifies that value has flowed to the named account, indicating that increase in the amount. Credit refers to an item recorded on the credit side of an account is said to be credited to the account. A credit entry signifies that value has flown from the source indicated by the name of the account. Debit and credit are simply additions to or subtractions from an account. We do not think debit always stands for decrease in amount and credit for increase. Then fifth one. When do the credit a liability account? What will you do to reduce the balance of any liability account? Explain with an example. Answer 5. Capital introduced is cash account, debited to capital account is credited. As in this case, we credit a liability account, we will debit the liability account to reduce the liability balance as loan is paid. The entry is loan account debited to cash account will decrease loan account or liability account. Then the sixth one, briefly state the rules of debit and credit accounts classified on the basis of accounting equation. Sixth one, answer 6. Debit and credit are simply additions to or subtractions from an account. We have discussed in chapter on accounting equation that by deducting the total of liabilities from the total of assets, the capital can be ascertained as follows. Assets is equal to liabilities plus capital, or capital is equal to assets minus liabilities. If there is any change on the one side of the equation, there will be change of similar amount on the other side of the equation, or amount are among the items comprised in the same side of the equation. When there is an increase in the account of an asset, its amount is debited. The account is credited if there is a reduction in the amount of the asset. When there is an increase in the amount of liability, the account is credited. The account is debited if there is a reduction in the amount of liability. When there is an increase in the proprietor's capital, the account is credited. The account is debited if the amount is withdrawn by the proprietor. The rules for debit and credit can be explained as given below. 1. Increase in asset are debits, decrease are credits. 2. Increase in liabilities are credits and decreases are debits. 3. Increase in owner's capital are credits and decrease are debits. 4. Increase in expenses are debits and decreases are credits. Increase in the revenues or incomes are credits and decreases are debits. 7th, in what circumstances does an account has a debit balance? When the posting of amounts in the debit side of a ledger is more than that of a credit side, then in that circumstance an account have debit balance. Then question 8. What type of account is a capital account and why? Capital account is a personal account. They refer to the accounts of the proprietor or partners who have invested in the business, that is, capital account of the owner. Capital accounts relate to persons, individuals, firms, companies, debtors or creditors, etc. are personal accounts. A capital account is the account of the proprietor and therefore is also personal, but adjustments on account of profits and losses are made in it.